G'day and welcome to the video. My name's Robert Gowdy and I'm from Consortium Private Wealth. What I thought I'd do today is have a look at just a really quick video about I suppose some research that Vanguard have done, and I'll just go to the next screen to give you a look at some of the research is done where it's comparing what's happening with obviously share market bull runs, when things go up, and also the bear years when things go bad. And I think it's really quite timely. It's very good research. Obviously, it shows the value of long-term investing. It also shows the old analogy where they talk about the share market going up with the escalators and down with the lift, and that is really highlighted by, you can see here over the last 40 years of investment returns, so going all the way back to 1980, that there's been 37 years of bull runs or positive growth years. Now there's definitely ebbs and flows during those years. I'd imagine that would be the tech wreck in there, given that Australia did not have many investment tech businesses at the time, that we really weren't hit so hard, but the US markets were. So you can see that over the time, the duration of the average bull run is over 9 years. And of course, when we look at the global financial crisis or go back to 87 and some recession years here back in early 80s, but before my time when I was watching, it's only around 3 years that we have these crashes. It takes up a very short amount of time, and before the market goes off again. Now, as a general rule, a lot of these peaks that we see here, the peaks here, the markets are more than likely, in hindsight, overvalued. So you really don't know they're overvalued until obviously there's a bit of a crash, and then the market will, oversell the market to a point where it's cheap. And I think where we are at the moment, we're definitely in that space, and this is the 3rd of April, definitely good value. The market has dropped by around 30% across most markets. So as a general rule, these crashes are short term. That's how they generally are, and the recoveries can be quite strong. Clearly, we don't know what this recovery looks like. This is extremely different, where businesses and job losses, businesses have gone down, job losses have been huge in a very short amount of time. So quite unprecedented when we think about that. So really, I think it's worth looking at, worth understanding that these crashes are generally short term. The share markets are looking 9 to 12 months ahead of itself, so it's factoring in worst case scenarios. Things, we may come through this a bit quicker than what everyone expects. Everyone's expecting bad news on top of bad news because that's what the media pushes at us. So we don't know if the market will go lower again, but based on what's happened in the past, we can see this will be relatively short term. It may be a bit longer. The average was 1 year in a bear market and a crash. It may go for longer than that. We don't know, but yeah, clearly an opportunity for people to invest. And yeah, so keep watching, keep talking to your financial advisor. But yeah, I think need to learn from history as a guide to the future. Thanks for listening. We'll speak to you soon.